Hi there. So in this series of videos, we're going to be looking at the basics of buy-to-let investing and actually if buy-to-let is still feasible in 2023. There's been a lot of changes recently in the law as far as lots more red tape coming through the Renters Reform Bill. There's been a lot of talk of reducing landlords' rights as far as putting more rights in favour of the tenants. There's been obviously interest rate changes. Interest rates have gone from historical kind of really lows right up to now to sort of 4.5% base rate. So we're seeing lots and lots of changes going on. So is buy-to-let even feasible in 2023? So my name's Sam Cooper. We've been investing in property since about 2010 when we let our first property out. We've got a small portfolio based up here in the Midlands. And we also run a property management and lettings agency that operates short-term lettings, so sometimes referred to as serviced accommodation, long-term lettings, so normal kind of family homes. And we're also involved in the supported living sector as well. So our company is called Coventry Accommodation Limited. And if we can help anybody with any property management needs in the Midlands, then by all means, please get in touch. So the way that we're going to work this is I'll give you a bit of an overview in this video of buy-to-let, kind of really the basics of buy-to-let. And then in future videos, we'll dig a little bit deeper into some of the more complicated bits and really show you how you can calculate things like mortgage coverage and rental yields and all that sort of stuff. But in this video, like I said, I'll just give you a bit of an overview of buy-to-let. So essentially what is buy-to-let? Well, buy-to-let is basically where you purchase a property, and that's normally referred to in the residential terms, but it could be commercial as well. So you'd buy a property, and then effectively you would rent it out for a rental income, and then hopefully your rental income coming in is more than your costs going out, so you essentially make a profit. But that property could be rented, as I say, it could be a residential property that's then rented as either HMOs. It could be a normal family home. It could even be rented as serviced accommodation. That'd still be classed as a buy-to-let investment. The fact is that you're buying the property and then renting out. Or as I say, it could be a commercial, commercial property, and that's whole another ball game as well. So, but there's quite a few terms that you'll hear throughout kind of your property investing journey, or if you're doing some investigations into the moment. So I'm just going to pick a few of them out, and like I say, in future videos we can dig a little bit deeper. So the first one I want to talk about was BMV, or below market value. Now this does get thrown around quite a lot, and everyone sort of says, "Yeah, I'm after a BMV property or a below market value property," and you've got to be a little bit careful with it. The last few years, it's been very difficult to get properties below market value because the market has just been crazy, and people have actually probably been paying more than the asking prices and more than maybe what the current value of the property is. But that's the point. The point is how do you ascertain what the market value of a property is? Because if you don't know what the market value is, how do you know if you're buying it below market value or not? And the whole point really with it is to build in some equity from day one. So when you buy the property, you're buying it with effectively a discount from market value from day one. And then normally the way you would find those sort of properties is essentially buying them normally from a distressed seller. So it's really a seller that needs to sell the property for whatever reason, and there's a number of reasons why people need to sell property quickly. And if you're in a position where you can offer them a really fast transaction, maybe you've got cash available that you can buy the property with, or you can move quickly with investor funds, and you can help them out of a situation, and in exchange they will agree to sell the property at a discount for you. But like I say, you really need to be careful who's setting that market value, and because if you're buying a property that's distressed, or you're buying it from a distressed seller, then is that really the same as the property being on the open market for everybody to buy? Good question, something to think about. The next thing I wanted to talk about was loan to value and leverage. So essentially, when you're buying a property and using finance, you're going to take a mortgage against that property. Effectively, the loan to value is the amount of loan that you're going to borrow, so normally a mortgage, against the actual value of the property. And again, we need to be careful with this word value, because there's two really kind of two types of numbers to kind of take into consideration here. So there's the value of the property, and then there's the purchase price. Now these two things aren't necessarily the same thing. So purchase price is what you pay, value is what you get, and they're not necessarily the same number. As I say, because if you're purchasing a property under certain conditions, so you're buying it very fast, maybe through auction, you could be paying a particular price for it, but actually getting a lot more value, if you were to then put the property on the open market. So normally, when we're talking about kind of loan to value, it normally relates to, let's say, the mortgage. Normally, with a buy to let, you would probably be putting a 25% deposit down, so you would be borrowing 75% of the property's value. So your loan to value is 75%. Your loan is 75% of the value of the property. Now, I've seen nowadays you can get 100% mortgages are kind of back in the arena for home buyers, but to be safe, around sort of 70-75% is generally a safe place to have a loan. You don't really want to be over leveraged. This is where a lot of people got caught out in the 2008 crash, where they'd borrowed like 110% of the value. And obviously then when the market sunk, so the market went down by 10%, your property is now, well, you owe 20% more than the property is actually worth. So a lot of people got burnt by that. So always just be careful with how much leverage you're actually taking. So the next thing I wanted to talk about was rental coverage. So this is where, again, if you're taking a mortgage on a property, the mortgage lender will probably insist that your rental income is higher than the actual mortgage, the mortgage payment that's going out each month. Might sound obvious, but what they tend to do is they do like a stress test. But what they'll say is your rental figure needs to be 25% higher than the interest-only payment on the mortgage. Or they may even say it needs to be 50% higher than the interest-only mortgage. So you'll get a figure for the interest-only mortgage. Let's say it's £500 a month. So if the rental payment's got to be 25% higher, your minimum rent that you can accept or you can take to get that mortgage would be £625. If your mortgage payment is £500 a month and your lender says, no, actually, I need it to be 50% higher, then your interest-only payment has got to be £750. And don't worry too much about this. We'll jump into some further videos about this a bit further down, in later videos where I can explain this a bit more. And the other thing to take into consideration is interest rates. Now, interest rates have changed massively, as I say, over the last sort of few years. We're currently at a 4.5% interest rate, and most mortgages at the moment are probably somewhere between 5 and 6% for buy-to-let mortgages in a company. So that means that your mortgage payment you're going to be making is going to be around that sort of figure, let's say between 5 and 6%. But what happens if those mortgage rates go up? What happens if we see more increases and they go up to 7%, 8%? So if you're assessing a property at the moment, I would be stress testing. Okay, what happens if my mortgage rate gets up to 8%? Is the rental income still going to be able to at least service the debt? And that's the main thing to sort of think about is can you will the property cash flow essentially? Will the money coming in be able to cover the mortgage payments going out? The next thing I want to talk about was adding value. So we would always suggest that you buy a property that you can add value to. Again, this is another way of building in some sort of safety in there. So it could be that you buy a property that needs a bit of a refurbishment. It could need completely decorating. It could need windows changing. It could need a new kitchen, a new bathroom. But when you get into the property investing arena, you'll find that actually to refurbish a kitchen or bathroom probably doesn't cost as much as you may think it is if you were a homeowner looking to refurbish a kitchen, for example. So you can make savings and you can add value as you kind of go along. And so you could buy a property, like I say, that's a bit tired, a bit run down, spend some money on it, do it up, and then boost the value of that property as well. And again, like I say, it just protects you from future future issues if there is a price correction sort of a little bit further down the road. And there's generally two returns that you get from investing in buy-to-let property. The first return most people kind of obviously think about is the rental return. So hopefully your cash flow coming in, so your rental income coming in, is higher than the costs of operating the property and paying the mortgage and that sort of thing. You might be making £200 to £300 a month more than than your outgoings. So that's the first return. So you're going to make a monthly net profit essentially on the income coming in. And then the second one is the capital growth in the value of the property. Now, this is never guaranteed, so it's not something that you should really bank on. But if you look at records of values of property, since records began, then essentially they've kind of doubled in value in the UK since records began every sort of 10 to 15 years. So I think it's a fairly safe bet to sort of say, if you bought a property now in 10, 15 years time, what's that property going to be worth? And the best way to look at it is go and talk to your parents or your grandparents, and just ask them, well, how much did you pay for your property back then, and how much is it worth now? And you can see the huge, increase in capital values over time. And like I say, it doesn't necessarily happen all over the country. There are pockets where, you get more capital appreciation and pockets where you get less capital appreciation. But it's something really where, some investors will just invest for capital growth. They're happy that the property isn't kind of cash flowing very much each month, And in some countries, they actually work on the fact that they're having to put money in each month to subsidise the interest payments going out. So actually, they're working on the capital growth. That's kind of their investment strategy. But in the UK, that's not something I would particularly suggest you do. I would always make sure when you buy something, you make sure that it's cash flow positive. So your rental income will always cover your outgoings. Well, I hope that helps for the first video. Like I say, we're going to jump into a bit more detail on some of these things in the coming videos. So thanks for watching. Speak to you all soon. Cheers. Bye now.